The International Energy Agency has issued a warning that the current oil glut could persist at least for the next 12 months. From as high as $120 a barrel in June last year, the global crude oil prices have plunged to $27 a barrel this month.
Well, initially there was a lot of speculation on what's causing this, including some geopolitical suspicions of, there's a state that's punishing another one and somebody wants another one to suffer. But eventually what has come out is there is certainly a significant oversupply of crude oil.
That geopolitical influence is Iran, back in the game after sanctions, including a cap on the volume of crude oil it could sell, were lifted.
They're going to have access to technology that's going to help them increase their production also quite significantly. It is said as things start today, it's possible for Iran to increase its production by something between 600 and 800,000 barrels per day within 2016.
Last month alone, Iran pumped 3 million barrels of crude oil. Saudi Arabia, which is the world's largest crude oil exporter, also stated that it could cope with the lower prices as producers pump 1.2 million barrels daily.
The US knows that it has increased production, it has caused the global oversupply, it is now starting to be more sustained in terms of oil supply. And then it was looking out to, so who will reduce production so that we can keep our prices high. Saudi Arabia refused to take the bait, and they refused to reduce production. And their big question is, why should I reduce production so that somebody else can produce theirs?
Nyaga says the low crude oil prices are bad for business.
So with $30 a barrel, it's not profitable for a lot of people. So explorers have almost no business putting much more money into exploration right now. You can't raise funds because you cannot even show the providers of finance that you're going to be cash positive at this price.
Global crude oil prices have been coming down significantly, and they've gone down by as much as 73%. Are consumers justified to ask for the same at the pump?
Now, the price of oil in Kenya is affected by a couple of things. One, of course, is the international market price. And the international market price, as you say, has significantly come down. That should be factored in the pricing of the local products. Whereas the regulator will factor in the reduced international price, then there's this other part which kind of stays static, so you're not able to see a linear reaction of the pump price.
What does it mean for Kenya when it comes to production timelines ever since we discovered oil in 2012?
If you're talking of a period of 5 years from now, that's not too optimistic, because it's expected that even the oil prices will recover in the next maybe 1-2 years as things start right now. So it's possible that we can produce oil by 2020. I don't think that's too optimistic.
To date, Tullow Oil has made discoveries in 8 blocks. As other global firms cut exploration expenses, Tullow says in a statement, "We continue to focus on driving down our cost and capital expenditure, and at the beginning of 2016, Tullow has a market-to-market hedge value of $600 million and financial headroom of $1.9 billion. However, Nyaga says the lower cost of fuel has positives, such as Kenya's import bill, which has reduced by more than a third.
The cost of finance is also likely to come down significantly, and that's a positive thing. And perhaps that's also the reason why you've been hearing that the balance of payments for the country itself, the balance of payments account is improving, because we're spending less dollars importing the same amount of oil. So that kind of helps on that side.
Ronald Owili, Business Insight.